Welcome to a brand new explainer right here on the GAAP Advisors Ind AS Clinic YouTube channel. I am absolutely thrilled to have you with us today because we're about to crack open a genuinely fascinating accounting mystery. We're looking at a classic scenario that honestly trips up so many finance pros, auditors, and investors alike. I'm talking about the true nature of redeemable preference shares. Like, are they a heavy liability just dragging down the balance sheet? Or are they equity padding out the company's net worth? Well, by the end of this explainer, you're going to know exactly how to decode this whole puzzle using Indian accounting standards. Now, before we get into the weeds, let's address the elephant in the room. Why should you, someone investing your hard-earned money in the shares of a listed company, even care about accounting standards? Well, trying to read a balance sheet without knowing the underlying standards, it's literally like trying to navigate a complex map using the completely wrong legend. If a company classifies a massive chunk of debt as equity, suddenly their debt-to-equity ratio looks amazing. The company appears artificially healthy, and boom, you might be walking straight into a trap. Accounting standards are the rules of the game, and to win the game, you absolutely have to understand those rules. Just a super quick but really important reminder before we jump into the case study. The views expressed in this explainer are entirely personal to the author and are not legally binding. Every financial situation is completely unique, right? So please make sure to seek the help of a qualified expert before taking or actually refraining from any action based on what we discussed today. Okay, let's quickly lock in our baseline rules so we're all on the exact same page. Our functional and presentation currency here is the Indian rupee. Remember, any currency other than the functional currency is considered a foreign currency. And our reporting period begins on the 1st of April and ends strictly on the 31st of March. Just keep that context in the back of your mind as we go. So the really intricate case study we're dissecting today comes straight from the massive issue repository on gapadvisors.com. This database is incredible. It hosts over 4,500 issues and detailed responses on Indian accounting standards and Indian GAAP. And get this, anyone can register for free right now. You can submit your own issues on Ind AS and Indian GAAP and get a detailed response delivered right to your registered email inbox. It is absolutely crucial for auditors who really need to document exactly how they addressed a specific issue relating to the application of Ind AS. To be specific, today's video explainer features a brilliant issue drawn from the 195th edition of the GAAP Advisors Task Weekly newsletter. This is authored by CA Manish C. Iyer, the director of GAAP Advisors, and it's published right on LinkedIn. There are actually over 230 editions of this weekly newsletter out there right now. So if you're on LinkedIn, definitely go ahead and subscribe for free to keep up with all this highly technical knowledge. Okay, let's dive right into this. Here's the setup for our puzzle. A company issues redeemable preference shares to its holding company, and crucially, these shares carry a cumulative dividend. But things take a turn. The issuing company suffers some major financial losses, which means they are completely unable to pay the dividend on these preference shares. Fast forward to the redemption date, both that cumulative dividend and the principal share value are still outstanding. And to complicate things even more, the holding company has actually gone into liquidation, so no formal claim is even made by them on the redemption date. Wild, right? So here is our core conflict. Where do these preference shares actually belong on the financial statements? Are we looking at a liability, or is this equity? And seriously, what happens to that accumulated, unpaid dividend? I mean, since the holding company is liquidating and hasn't even asked for the money, can the issuing company just kind of shrug it off? Maybe just classify the unpaid dividends and unredeemed shares as a mere contingent liability? Now, what's really interesting here is how paragraph 11 of Ind AS 32 completely cuts through all that confusion. It fundamentally defines a financial liability as a contractual obligation to deliver cash or another financial asset to another entity. Since our case involves preference shares that are both redeemable, meaning the principal eventually has to be paid back, and cumulative, meaning missed dividends pile up and must be paid, the company has a strict, unavoidable obligation to deliver cash. They literally cannot get out of it. So the crucial point is that this instrument is undoubtedly a financial liability, period. It must be presented as such on the balance sheet at amortized cost. It is absolutely not equity. The company owes this money. Plus, the dividend cash flows are intrinsically included in the effective interest rate calculation, which means they're recognized as interest using the effective interest method. But wait a second, what about classifying that unpaid accumulated dividend? Given that the holding company is liquidating and nobody is knocking on the door asking for a check, can the issuing company just brush it off? Can they just shove it into the footnotes as a contingent liability and move on? And this brilliantly illustrates the elegance of the Ind AS framework. Take a look at paragraph 2 of Ind AS 37, which governs provisions, contingent liabilities, and contingent assets. It explicitly states that the standard does not apply to financial instruments that are within the scope of Ind AS 109. Since our preference share liability already falls squarely under Ind AS 109, neither the dividend cash flows nor the redemption cash flows can just be disclosed as a contingent liability. They are real, fully recognized liabilities. Let's look at how this builds right into the strict rules of derecognition. Paragraph 3.3.1 of Ind AS 109 really lays down the law here. An entity can only remove a financial liability from its balance sheet when it is entirely extinguished. And extinguished means the obligation specified in the contract is officially discharged, canceled, or expires. You can't just pretend a debt doesn't exist anymore just because it's inconvenient or because the other party is distracted by a bankruptcy proceeding. So here is the ultimate reality check for our case study. Just because the holding company is in liquidation does not mean the debt vanishes into thin air. The preference shares and the accumulated dividend haven't been redeemed. The mere event of the holder going into liquidation, that does not give rise to a derecognition event. The absolute only way this liability leaves the balance sheet is if the liquidator officially and explicitly waives the right of the company to claim the amount from the subsidiary. Until that formal waiver happens, that liability is staying firmly anchored on the balance sheet. You know, financial instruments can be incredibly complex, and getting this stuff wrong has massive implications for financial reporting and investor trust. If you're grappling with your own Ind AS and IFRS issues and need some precise expert clarity, you can actually book a one-on-one consultation with the author of today's case, CA Manish C. Iyer. Just head over to his page on topmate.io to schedule a deep dive into your specific accounting challenges. Thank you so much for your time today. Now, if you found this explainer valuable, please hit that like button on this video. Drop your thoughts or questions in the comments below, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. We'd also really appreciate it if you shared this explainer among your contacts, colleagues, audit and finance teams, and especially students pursuing their CA course. It really helps spread this vital knowledge of Indian accounting standards. Oh, and make sure to follow the GAAP Advisors Ind AS Clinic channel on WhatsApp for instant updates on all our videos, podcasts, newsletters, new issues we've responded to, and new standards issued. Finally, for a deeper audio dive into the exact issue we just tackled, connect to the GAAP Advisors Ind AS Clinic podcast, which is available right now on Spotify, Amazon, or YouTube. I'm going to leave you with this final thought to ponder. The next time you're looking at a set of financial statements, ask yourself, how many supposedly extinguished liabilities might actually be hiding in plain sight, just waiting for a liquidator's claim? Keep your eyes open, rely on the standards, and keep learning. See you in the next explainer.